Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in Europe with high-yield borrowers, borrowing more than $115 billion already, more than half the total raised in 2017's banner year, with 8 months still remaining on the calendar. Longer-dated high-grade debt regaining its luster in the US. Norfolk Southern selling $600 million of 100-year corporate bonds, the first to hit the market since 2018. And the borrowing blitz continuing in America as well in high-yield markets, the primary market heading for the busiest first half ever after pricing almost $200 billion already, with roughly 2 months still remaining. Kathy Jones, Jim Karen and Jim Bianco back with us. Kathy, I just want your view on credit right now. Spreads are super tight. I'm on repeat at the moment. Very tight, through the previous cycles tight. And there are a lot of people out there starting to pull back. And I caught up with Rick Reeder earlier. He was one of them who said he was raising some cash. What's your take on that, Kathy?
Yeah, particularly at the very low end of the credit spectrum, triple Cs, when you look at that, I mean, they are absolutely priced to perfection. So default rate of, say, 10%, and you're lucky to make zero on that trade if you don't lose money on that trade with the yield so low and spread so tight. So it's not that you pull back entirely, but I think that you have to pick your places pretty carefully. If raising cash would make sense to me. I feel like we're in this keep dancing until the music stops moment. You know, you don't want to be the one left on the dance floor.
Jim Karen? I don't think we've got Jim Karen there. We're going to bring Jim Bianco in for more. Jim Bianco.
Yeah, I would agree with a lot of what Kathy said, that you got to keep dancing, you got to keep playing. And one of the things that might be driving all of this is what the Fed did last year, and that they came in and they purchased high-yield bonds. They purchased corporate ETFs. They sent a very powerful signal that they were there to make sure that if there was any disturbances in that market, that they would play along. And then at the end of the year, when the old administration pulled back on some of those programs, you heard the Fed complain about it as well, too. So there's this belief that, yeah, if you look at traditional fundamentals or traditional metrics in the high-yield market or investment-grade market, it doesn't provide you with a lot of comfort that you're paying up for a lot of those bonds. But then you've got a big player with a printing press behind you that's going to make sure that you come out whole in that market. So it's really making people reach for a lot of risk.
Yeah, and looking at the line coming out of M&G Investments, Bond Vigilantes is the handle on Twitter. This is the line. April saw 0 high-yield defaults for the first time in 2 years. At the same time, it was the 5th biggest month for high-yield issuance in history. Of course, a lot of that was refinancing. Bank of America saying rating upgrades are setting all-time records, and there's more to come. Kathy, it's hard to lean against that too hard.
Yeah, absolutely. Again, you know, you've got everything on your side. You've got easy monetary policy, you've got expansive fiscal policy, and you've got an improving economy globally and domestically. It's hard to lean against credit right now. I just do think you have to be cautious about what risks you take.
Well, let's talk about whether you should be holding cash. I caught up with Rick Reeder at BlackRock, mentioned that just moments ago. Take a listen to what he had to say.
We definitely run in a lot of cash in the portfolios. We are, you know, some of this exuberance argument and this overheating does give you a bit of pause. When the Fed puts $120 billion a month into the system, and then you get the Treasury pay down, the TGA drawdown, that puts another, you know, depending on timing of how you look at another $500-600 billion over a quarter into the system. There's no question why the money's got to go somewhere, and this is part of why, you know, that exuberance. It's not because people want to buy at levels they're buying at. It's because there's just too much liquidity floating around the system. We just cut all that out, rather sit in cash, and then take where we think there's upside convexity.
Just that piece there on the cash position, Kathy, I'd love your view on that. We're going into a really delicate next couple of months. The data could go either way, as we've seen this morning. Who knows? We've got to be humble about this moment. But most people assume that the taper debate is just around the corner, deeper into summer. Do you want a cash position going into that? Rick Reeder at BlackRock seemingly does. Do you?
If I thought that the Fed was going to announce tapering this summer, I would probably be building cash. I'm not convinced that they're going to announce it, you know, this summer at Jackson Hole. They may push it back even further, depending on the data. They talked about wanting to be patient. So I wouldn't be really increasing cash a lot at this moment, because it's not going to pay you much, and especially if you're depending on tapering to be the catalyst for a big move.
Jim Curran of Morgan Stanley back with us. I understand we've re-established that technical problem. Jim, just to bring you back in, Rick Reeder of BlackRock joined us a little bit earlier. He was talking about building up a cash position, maybe in the mid-teens going into summer. He's a little bit cautious, less constructive, let's say. Is that anything that resonates with you, Jim Curran?
I think in the mid-teens, it's probably a little bit high. Right now, we think that we're in a very stable yield environment. Curves are steep. There are places to look around, whether it's in credit or even in some emerging market spaces, or even in some of the developed markets where yield curves are steep. That I think, probably having a decent cash holding in the 5 to maybe 10% range would be okay. But I think anything beyond that might seem a little bit excessive, at least to me.
Jim Bianco, your reaction?
Yeah, I think that cash is a good place to be, especially if you think that rates are going up. Duration is something you want to hold less of, and naturally, as you move down the curve, you're going to wind up at the end of the curve, which means that you're going to have a little bit more cash. But I also agree with Kathy. If you're holding cash because you think the Fed is going to make some kind of an announcement about tapering at Jackson Hole, you might be a little bit disappointed. So if it's a part of a directional bet on rates, I would agree with holding more cash.
Well, let's talk about the move on rates. 30s are up 3 basis points right now. 10s are up about a basis point after the big move we saw early this morning. Before today, though, Kathy, we'd spent the whole week saying data's solid, better than, it's good, yet yields aren't going higher. Why not? Have we had an answer to that this morning?
Yeah, well, maybe the bond market really is the smart market, as people like to say, and maybe it was an indication that there were some doubts out there more than say was printed by the economists. But I would also say, look at 150 to 160, we're kind of fairly priced for an improving economy, but not a robust economy. And we have higher inflation expectations, but we need to sort of realize that inflation. So I think this is a resting place. I think if the Fed keeps policy aggressive, we will start to see the long end continue to move up in a steeper curve.
What are your thoughts on that, Jim Curran?
Yeah, so I agree with what Kathy's saying. I think the 150 to 160 area seems to be the center of gravity for now. I broadly put the range at about 1.4 to 1.8% in the 10-year. Look, I think what the market's looking for right now is the next catalyst to make rates move higher or lower, but I think the majority would believe that it's probably higher rates. But what's the catalyst? We already know inflation is going to print really big this quarter. We know that core PCE is probably going to 2.6%. Headline CPI might even go up to 3%. So all of this is baked into the cake. So if that can't get the 10-year yield moving higher right now, then what's the next surprise that's going to do it? Maybe it's the wage inflation that Jim Bianco, was discussing earlier that could be the catalyst that does it. But until we see exactly what that is, I think we can sit in this range for an extended period of time.
How many people would have said the curve would be steeper at the end of the day after the print we got this morning? If I told you what that number was going to be yesterday, in secret, of course, not that I knew the number, would you have thought that the yield on a 30-year would be up 3 basis points at the close of the day and the curve would be steeper? Jim Bianco, just a final word, please.
Yeah, no, that is a big surprise. And if I was to put my technical analyst hat on, I am a chartered market technician from way back when, this gigantic move down in yields in the reversal intraday smacks of some kind of an important day from a technical standpoint that we might have seen the low, at least since the March high in bond yields earlier today, and that we're in some kind of a reversal pattern. Still early days. We'll see what happens this afternoon, but it is an important pattern to pay attention to if we do wind up continuing to grind higher for the next couple of days, that it looks like some kind of exhaustion was hit with the bond market and a reversal's underway.
Hey, Jim, great to catch up, to get some final thoughts. Jim Bianco there of Bianco Research, Jim Curran of Morgan Stanley, and a tremendous friend of this program, Kathy Jones of Schwab. Still ahead, the final spread, the week ahead, featuring another massive stretch of Fed speak. That conversation up next. This is Bloomberg.